Money Masters Worldwide.
Learn to invest right now.
Yeah, hello Gary. This is Robert speaking, and thank you again for giving us the opportunity, as I just told you in the talk we had in advance. But you are based in California right now. Is that true?
Yes, I'm in Northern California, Robert.
Are you actually from California, or are you just are traveling there?
No, I'm actually from here. I was born in Los Angeles, and I've lived in Southern California and Northern California
I see.
pretty
All right.
much my whole life.
I see. Okay. Very good. Yeah, so I'm based here in Hamburg, so obviously you're probably going to have much better weather. And also my friend Eric, you're in Miami again, right?
Correct, yes. I think we kind of have an advantage in terms of climate over you, Robert. My apologies for that. I heard that fall is starting now in Germany.
Exactly. So we have blue sky today, but I guess we cannot really compete with you guys, unfortunately. Okay, so again, I think we should maybe get into the questions that we have. And Eric, why don't you start with your first question, please?
Sure. So Gary, I'm really curious about your background. So if you don't mind, would you tell us about your childhood, how you grew up, and what got you first interested in investing or finance in general?
It's kind of an unusual background. My mother and stepfather were professional card players, so that got me thinking about risk and return at an early age. And one of my grandfathers said he was going to give me a number of stocks when I became 21 years old. And he told me what stocks they were, and I started following them as a child. He never gave them to me, but it still piqued my interest in the stock market. And then when I was in college, my other grandfather had been subscribing to the International Harry Schultz newsletter, which he'd sent to me after he read it. And I was amazed to see that Harry Schultz actually seemed to have an edge on the markets. So when I was in college, I took my meager savings one day after reading in the newsletter that the Japanese yen might be revalued, and I went to my local bank. They thought I was crazy, but I asked them to convert all my dollars into yen. And several weeks later, I had a 10% gain when the yen was revalued. Then later on, this was after college, I believe. I read in the newsletter something about a company called Sanyo Electric, which no one had heard about, a Japanese company. So being in Los Angeles, I could actually find a Japanese stockbroker who spoke very little English, but somehow I was able to convince him that I wanted to buy Sanyo Electric, and I had a 40% gain in a short period of time in that, and I was hooked.
Very interesting. So it's kind of like reminding me of Warren Buffett, who says that he's bought his first stock when he was 11 years old. So it seems really like when you start young, you really get an advantage over other people. And the joke that he always makes is he was wasting his time up till then. So really interesting to see that you got a early start as well.
Also interesting to hear, Gary, is that actually Robert and we're connected through our college time because we both studied business administration with focus on Japan. So our passion lies within Japan. Actually, Robert got married to his passion, so his wife is from Japan. And my business is in relation to Japan, consulting businesses that want to export to that country. So very interesting to hear that your first endeavor with investing was through a Japanese stockbroker.
Yes, what is interesting is that there's a home country bias usually. People don't look outside their own country very much. And that was interesting about the International Harry Schultz newsletter. He was based in Switzerland, and he had an international perspective, and it served him very well.
Very good, very good. So we're also going to talk about things like international stock picking and these kind of things later, because obviously you have a very special strategy, which is combining U.S. stocks and international stocks. And we are based, or I'm based in Germany. Eric is from Germany as well. So this is something we will get into later. So first of all, maybe you can explain a little bit more about your dual momentum investing strategy. What exactly is that?
Well, you have to understand what dual momentum is. There's actually two types of momentum. Most people are familiar with the relative type of momentum, sometimes called relative strength. And that's where you compare the performance over a specific look-back period of one asset to another, and you invest in whichever one has been stronger. Now, that type of momentum was actually discovered back in 1937 by two economists, Cowles and Jones, who found that stocks in the U.S. that had outperformed during the preceding year tended to outperform going forward in time. However, there's a second type of momentum called absolute or time series momentum, where you look at performance of an asset itself over time. For example, if the S&P 500 index has gone up over the past year, you say that it has positive absolute momentum, and it should continue to go up because momentum means persistence in performance. So what I did back in 2012 is I said, well, why don't we take both forms of momentum and put them together and see what happens? And there was a very interesting synergy that happened because if you could cut off your downside exposure to a great extent, that accentuates your upside exposure because you don't have losses that you need to recoup as you go forward in time.
So it really sounds very simple, but it has a great effect. And there was nobody ever who did this before you, right?
There are people who have combined trend with relative strength in more of a ad hoc manner. H.M. Gartley back in the 1930s actually said, buy the strongest stocks in the strongest industry when their trend is up. Mm-hmm. But no one had actually gone through in a systematic way and put it together in the context of momentum research. Mm-hmm. Meb Faber had done some work on this prior to what I had done, but he used somewhat different methodology for doing it.
All right. I actually just started listening to Meb Faber's podcast, so yeah, that's a familiar name. Eric, you just have a question? Yeah.
Yes. So you already explained what momentum actually is. I'm curious to maybe better understand what the difference between momentum, trend, and growth is.
Actually, momentum is trend. It is, all momentum is trend following, although people don't usually think of it that way. It's trend following because you're exploiting the serial correlation that persists over time, either between assets or of an asset itself. And relative strength is identifying a trend of one asset being stronger than the other. Now, people usually think of trend following as something applying to just a single asset, which is very close to what absolute momentum is, where you're looking at one asset's performance over time and saying, okay, if it's gone up, then the trend is positive. And often people will use moving averages or some other technical indicator for that. But research has shown that absolute momentum, which is just a simple way of looking at an asset with respect to its performance over a specific period of time, that's actually outperformed moving averages and other ways of looking at trend. Now, growth has to do more with fundamentals. You're usually looking at earnings momentum when you're speaking about growth, but that is a form of momentum as well. And some studies have looked at growth in terms of momentum. So momentum is pretty inclusive. It includes everything we've talked about, but you don't want to limit it to something like growth or trend following.
Okay. Mm-hmm. I'd like to talk a bit about the actual performance of dual momentum investing. What could we expect and how consistent are the results?
Well, first let me say that past performance is never any assurance of future success, but the back testing on momentum has been extremely positive. With my dual momentum approach, which is very simple. It only uses a 12-month look back that was discovered in 1937, and it only uses three assets: U.S. stocks, non-U.S. stocks, and intermediate-term bonds. And just using that simple approach with dual momentum, we've been able to achieve a 600 basis point increase in return over the S&P 500 since the 1970s. And right now I've been able to get some data going back to 1950, and it looks like this is held up back to then as well.
Mm-hmm. Very good. So Gary, in your book you state that in the backtest that you also just mentioned from 1974 to 2013, as it says in the book, the dual momentum method produced an annual return of 17.43%. I assume that this is pre-tax and without consideration of the transaction costs. In the same period, the All Country World Index had an annual return of 11.52. But I guess that when investing passively in All Country World Index, you have zero transaction costs and taxes to pay until you decide to take your money out again. So how much impact have taxes and transaction costs on the return of dual momentum? And will they eat up the advantages over a passive investing approach?
The dual momentum approach I use has on average 1.3 trades per year, so it doesn't trade very much, and most of the gains are long-term capital gains. In fact, over 70% from the gains from my dual momentum model are long-term capital gains. Now, the fact you mentioned that with ETFs, you don't pay capital gains until you sell them is true, but interest and dividend income are taxed as you go along, whether you're in an ETF or not in an ETF. And people don't realize that historically, over 40% of the return from the S&P 500 index has been in the form of dividends. Mm-hmm. So you have to keep that in mind as well when you look at this.
All right. Okay, so there's still a big margin that is really relevant comparing dual momentum and a passive investing approach, right?
Correct.
Okay,
yes.
Very good. So in the current market situation with the Shiller PE, or also called CAPE ratio of the S&P 500 and also the Buffett indicator being extremely high, meaning that the stock market seems to have nowhere to go but down sometime soon, it feels counterintuitive to heavily invest in stocks right now. So wouldn't it be smarter to wait for the next crash and then invest and to buy low?
Well, people thought that in 1999 as well, and they were correct. The S&P 500 index over the next decade was down 9%. However, the dual momentum approach that I use had really good gains during that period because nothing goes straight down or straight up. There were enough vacillations between stocks and bonds that we were able to jump from one to the other and do very well. You also have to keep in mind that things like the CAPE ratio do change over time. The median value has risen. Interest rates are now relatively low to what they've been in the past. So there's no saying that stocks won't go considerably higher from where they are now before their performance does erode. So you would be making a guess if you were to stand on the sidelines right now. Whereas with dual momentum, we have a systematic approach that will take you out of the market when it identifies the markets are no longer positive.
Okay. So
we've talked.
One thing. So let's say, for example, there's going to be a crash in 1 year, for example. So you say it's better to start investing your way right now. And then let's say your strategy takes me out of the market again in 1 year and a half, for example. Then it's still going to pay out for me, having used the couple of months left until the next crash, right?
Well, you can't really say anything about short-term performance. I would encourage people not to look at short-term performance or to anticipate short-term performance. But over the long run, it makes sense to use dual momentum and disregard other factors, except perhaps once in a while let's say that stocks have crashed already and the Shiller P's are mid-single digits, there might be some buying opportunities then, but those don't come along very often, maybe once every 20 or 30 years.
Mm-hmm. Okay.
We've talked about what momentum investing is, that it's actually working. For me, what is not 100% clear yet, why is momentum investing working?
That's a good question. People have wondered that ever since academic research was done. The best explanations for it seem to be behavioral, and there's been a whole body of research done in this area. So what happens basically is that, let's take stocks for example, they initially underreact to information coming into the marketplace. And this is caused by an anchoring effect. People just don't want to give up what they're doing. It's also caused by disposition effect, where people tend to sell their winners too soon and hold on to their losers too long. So what this does is it causes prices to be restrained initially when information enters the marketplace. Now, eventually, people catch on to what's going on, and prices have to catch up with their fair value. And when that happens, there's actually a continuation because of overreaction. There's what's called the bandwagon or herding effect. People like to go along with the crowd. There's recency bias, where if people see something moving along, they think it's going to continue in that same direction. So that causes people to be confident in price continuation, and that can actually lead to overconfidence and over-continuation of price trends.
That's a good point, because that would be my next question. If momentum will actually work forever, for example, if everybody started momentum investing, will the economy be able to grow forever?
Well, stocks should do well forever, assuming economic growth doesn't disappear, which is would be a very tenuous assumption. Now, if stocks do well, I don't see any reason why momentum shouldn't do well, because we're basically in stocks as long as the trend is positive. As far as these behavioral biases, they're pretty deep-seated. Something like herding is ingrained in all of us. It's what keeps animals surviving in the wilderness. So I don't see any those things disappearing or changing either over the long run.
Mm-hmm. And are there any disadvantages and risks related to dual momentum investing?
Yes, there are, of course. Every approach has risks associated with it. There's always the risk that the future won't be like the past, but momentum has been back-tested, both relative and absolute momentum, back to the year 1801, and is found to outperform buy and hold. Absolute momentum or trend has been tested back to the beginning of stocks in the 1600s by Grazeman and Kaminsky, and it's also been found to hold up. The big risk, I believe, is behavioral, in that people may react or overreact at the wrong times to their detriment. Emotional biases are, as I mentioned, are hard to overcome. So with momentum, you will have periods of underperformance, like anything else. In bull markets, sometimes with absolute momentum, you'll get whipsawed. There'll be lags and leads getting in and out of the market. So people may become impatient, and they may get in or out at the wrong time and disregard what momentum's trying to do for them. So I consider that the biggest risk factor with momentum investing. And I've seen it happen. People who've been invested with my models, even the proprietary models, when we have a period of underperformance, they tend to forget how momentum has advantages over the long run, and they react myopically and move on to something else.
So probably a robot would be much better in doing this than a human being, right?
That's correct.
All right.
as in many cases, the human part is the highest risk.
Yeah,
that's very true.
Okay, Gary, so in times of a market crash, we would shift the assets to bonds according to your strategy. But what if at the same time there's also hyperinflation, like we have seen in Germany in the years from 1914 to 1923? This would have a very negative impact on our bonds, right? So is there no safer place to put the money?
Yes, in a hyperinflation, a safer place is the stock market. In the 1920s in Germany, the stock market did very well during the hyperinflation.
Yeah, but
now
that's not
now
our strategy, right? Yeah.
Now, what you mentioned about dual momentum getting you out in times when market crashes, that's a little bit off. What it tends to do is get you out before the crashes occur, because it identifies loss of momentum while the market's building a top. So when the crashes are going on, we're usually safely on the sidelines. Now, if we were in a hyperinflation environment or any environment in which bonds were not doing well because of something anomalous like that, you would just use some common sense and be in something more liquid like treasury bills, or you might want to hold a little gold or Bitcoin, something like that. So you have to engage your brain. Nothing is 100% robotic, although some of the decision making, like you said, we'd be better off if it were. You still have to use your brain a little bit here.
Okay. All right. So, Gary, what are your thoughts on combining dual momentum with a value investing approach? And what would be the best way to do this?
Well, I've tried taking value-based ETFs and incorporating them within the dual momentum model. It doesn't add anything. So really what you'd want to do is take momentum and value as separate sleeves and invest in them separately. Now, if you were going to do momentum with stocks, there's some benefits to doing that. You can decrease your volatility, and it helps your overall portfolio. But trying to combine a value sleeve with dual momentum, the value is going to be overwhelmed with it, and it really has no place. Where value might be useful is, as I mentioned before, once in a great while, when stocks have been hammered really hard, and the PEs are down to 5 or 6 or 7, you might want to step in and buy stocks or stock indices based on that, because it's unlikely stocks will stay at that level because earnings go up over time. So unless PE ratios went further lower and stayed there, it's pretty much given that stocks will rise once they get hammered that low.
So let's say there's a crash and the stocks are really undervalued. You would look at the CAPE ratio and then decide to re-enter because the CAPE ratio of the ETF, of, let's say the S&P 500 is at a certain level, and then that's a signal for you to re-enter the market, right?
You could do that. I prefer to just use dual momentum because it won't get you in right at the bottom, but using CAPE ratio or PE ratio may not either. So I prefer just to stay with dual momentum myself, but I find nothing wrong if someone wants to enter stocks when they get hammered extremely low.
So as I understand, the momentum and value are a little bit like yin and yang, you could say. That they are negatively correlated, if that's correct. So, I mean, and let's say nowadays the market is really high, so momentum is probably performing better, I would assume, than value. And as you said, after a market crash, value is performing better than momentum. So would it make sense to adjust your, as you just said, you have a portfolio, maybe 50% in value, 50% in momentum, but then in certain times to adjust to a certain direction? Would that make sense?
Well, the momentum and value premiums are negatively correlated, but not the funds themselves. The market influence dominates both. So if the market goes down, they're both going to go down, and the market goes up, they both go up. And my research has shown, as I mentioned, there's really nothing to be gained by adding value to dual momentum. Now, if once in a while you wanted to make a value type investment because of unusual situation of stocks being extremely undervalued. There's nothing wrong with that. You have to make a decision then of when you're going to get out as well.
Okay. Since bear markets tend to be shorter than bull markets, wouldn't it be a good idea to use shorter look-back periods while being invested in bonds to be able to re-enter the market closer to the bottom?
There's some merit to that idea. The problem with it, though, is how do you know when you've been in a bear market long enough for that to happen? If markets go down for a certain amount of time or a certain amount of price, and you get in early, they could very well reverse and go back down, and then you'll get whipsawed if you're using a shorter look-back period.
Okay. And 12 months is the ideal look-back period for you, right?
It has advantages. It was discovered in 1937. It's held up well since then. Jagadish and Titman, in their seminal work in 1990, 1993, also found that it worked better than other look-back periods. My own research has shown that it works a little better. And there are tax advantages because it trades infrequently compared to shorter look-backs.
Okay. So if an average private investor wants to improve the performance of your strategy, would that be possible, and what would you advise that person to do? And the same question also for maybe more sophisticated, maybe also professional investor.
Well, it's always possible to improve on prior work. That's what progress in the world is based on. But you have to be very careful in doing it. My latest blog post is called it's The Perils of Data Mining. And it identifies a lot of instances where people have tried to improve upon dual momentum, and because they didn't have enough data, things they thought were improving on it were actually making it worse. So you have to be careful. You have to think, well, does it make sense? Do you have enough data so that you can rely on your backtest results? And do you really want to make things more complicated? Simpler is usually better. For somebody who isn't satisfied with 600 basis points more a year that my generic dual momentum model offers, that's written about in my book, I do have proprietary models that can be licensed from advisors. There's a handful of them that I work with closely and that I license these proprietary models to.
Eric?
Yeah. So I would like to ask specific questions for our listeners in Germany. What do you think are the necessary adjustments that your dual momentum investing strategy for people in Germany have to make? Would it be possible to have a bigger focus on German stocks, and what would be the consequences?
That's a great question. I do have a blog post called Dual Momentum Investing for Non-U.S. Investors. And we go through all different kinds of scenarios. And the conclusion we come to is try to be as close to the U.S. model as you can. Excuse me. Now, in Europe, it's not possible to invest in the all-country world index ex-US. It's not available. So, but you can construct a surrogate for it by using the MSCI indices for Europe, Pacific, and emerging markets, and just combine those together in the appropriate percentages so that it replicates the ACWI ex-US index. Now, because of home country bias, if someone wanted to incorporate their own country stock index, they could certainly do that. You could add the DAX to the model, or you could substitute DAX for the Europe index. And if you gain more benefit from that psychologically, that would seem to be a fine thing to do.
Okay.
All right. So For example, if somebody had 100,000 euro in cash sitting on a bank account right now, what would you advise the person to do with it if he or she wants to invest it? Invest it all at once in dual momentum, or would it be better to split it up in tranches and then to invest them over a certain period of time?
That really depends on one's risk preferences and one's attitude towards regret, depending on what you do or don't do. From an economic point of view, the numbers would tell us it's better to just jump in all at once and let dual momentum take care of the risks involved. But people are psychologically all different, so I can't really tell anyone what to do in that respect. It's up to each individual.
Okay, all right. So let's move on. So we have a new section here we call speed dating section. So that means that we will ask you a couple of questions and would like you to answer them with not more than a few words or sentences. And I would like to hand over to Eric, who will do this, ask you a couple of questions and try to get as much information from you as possible in a short amount of time.
And who will be my date?
I'm sorry, but you have to go with Eric.
Okay. Maybe we should add a nice lady to our podcast.
Yes,
next time. Would be more appealing to our guest, I think, than me doing the speed dating.
Well, we should change the name of the section, maybe.
Please bear with me, Gary. Sorry for the moment. All right. So question number one, what should the minimum time horizon be when applying the dual momentum strategy?
Longer the better. I'd say a complete market cycle is what you need in order to gain the full benefits from dual momentum. That's a bull market and a bear market. And that usually takes at least 10 years, sometimes a little more, sometimes a little less.
Okay. Mm-hmm. And why not use momentum ETF instead of switching between US and non-US stock ETFs?
Well, they're looking at different things. Momentum ETF is just looking at U.S. stocks, or they have international ETFs too. But that's on the stock level where you're picking the strongest momentum stocks. And there's a lot of controversy in terms of how these have done and what the impact will be when more people start doing it. Robert Arnott of Research Affiliates has shown that stock momentum has underperformed since 1999. None of the momentum funds that have been around 10 or so years have outperformed their benchmarks. So over short periods of time, they may do well and have done well. But there are some doubts about stock momentum that people need to be aware of. I've written about it in some of my blog posts and their research papers about it. Now, when you're applying momentum to international stock indices versus, say, the S&P 500, that's a whole different issue. You're really dealing with global economic trends, macro trends, which is reflected in the strength or weakness of currencies. You can see a correlation between the strength of the dollar and the strength of U.S. stocks versus non-U.S. stocks. And that all reflects global macro factors.
If somebody, for example, says to you in regards to dual momentum, usually when things look too good to be true, they're not true, what do you reply?
I would say set your biases aside, that bias and any other bias, and do a study. Look at the data, look at the research, and see if you still feel that way. To just make that statement without doing your homework is not going to do you any good. There's plenty of research out there on momentum. You could read my book, you could read my blog posts that deal with things that have come out since my book was published. You can go to all the research papers out there. You can do your own research and then see what you feel.
Mm-hmm. How widespread is your strategy inside the US and also outside of the US? Do you expect it to become much more popular?
It's not as widespread as I thought it might become. I think because of the same biases that make momentum work are also biases that keep people away from it, especially the way that I use it. You have home country bias. You have a bias of familiarity, which is very strong. People don't adopt something that's new and unfamiliar to them very readily. You also have the fact that trend following has been looked down upon in the academic world for a long period of time. It's only been in recent years that academics have come around to saying that there is something there that can be recognized and exploited. So I think it's going to take a while, and I don't know if it's ever going to catch on to a great extent, because what I do is very simple, and there's also a strong bias towards complexity. Even though complexity is usually not as good, people will pay up for it, and that's what they prefer because they think more is better. But that's often and usually not the case.
We've talked a lot about the stock market in general. What was the best investment you've made outside of the stock market?
On a longer term basis, it was in the 1980s when I put together commodity pools using some of the best commodity traders in the world, people like Paul Tudor Jones, Richard Dennis, Louis Bacon, Monroe Trout, John Henry. We made over 25% a year for close to 10 years with no losing years. That was a pretty incredible run. On a short-term basis, I did very well in the late 1970s trading stock options, and I did very well last year trading Bitcoin.
Right.
Mm-hmm. Mm-hmm. And what was your biggest mistake you made in the field of investing?
I'd have to say overconfidence. Mm-hmm. When I did really well in the 1970s trading stock options, I thought I was really good, and I was actually really lucky. Now I'm much more diligent in the research that I do, much more careful in doing things than I used to be. So I'd say when you have success initially and it comes easy to you, it's easy to become overconfident, and that's a problem that I'm sure other people have as well.
Mm. When you just want to wind down from a stressful day, maybe only in relation to investing, in the past or in the present, what was your way to relax and reset? Do you have any morning or evening routine?
I meditate every day. That's very helpful. I also try to exercise. I'm fortunate in that I can work from home, so I let my dogs take me for walks every day. Mm-hmm. And I just try to lead a balanced life as best I can.
Mm-hmm. And what do you expect investing to look like in 20 years from now?
That's an interesting question. I think 20 years from now, people will see that all this emphasis on factors is what it really is, which is something that really may not offer an advantage after costs to the market itself. So I think you'll see a continuation of interest in passive type index funds, although there are always going to be biases against that. People will always think they can do better than the market. So we'll see people continue to try to come up with other things. Hopefully by then they'll be more convinced about dual momentum. I may not be around when that happens, but I expect eventually the stones will cry out the truth and people will catch on.
Do you think that artificial intelligence will play a role in investing in the future?
It's playing a role right now. You have things like that going on, but people don't talk about it. They wouldn't want to give away their edge. But there's no substitute for the real thing. Mm-hmm. You still have to have sound and sensible ideas underlying the logic of AI, and there's no substitute for that. And sometimes people get enamored or caught up with technology, and we've seen that in the past. For instance, long-term capital management, people got caught up with modeling, and they didn't consider other exogenous factors like liquidity. So there are always going to be room for the real kind, as well as the artificial type of intelligence.
Picture yourself at the age of 20. What advice would you give yourself?
I would try to do more with my life that would benefit other people and benefit the world. I don't think I would have taken the same career path that I've taken.
And the same thing for the age of 40?
Would have tried to be nicer and kinder and done more for others. Just lead a more balanced life. I doubt if very many people, when they leave this world, think they should have worked harder. I think there are other things that are important in life that people need to pay attention to.
Yep. If somebody is new to dual momentum investing and wants to get started, what are the first steps to take besides reading your book, of course?
I have some blog posts that have come out since my book that update people on research that's come out since then and other thoughts and ideas since then. So I'd say that's a good place to start in addition to my book. And both of them have links to all kinds of other sources, research and otherwise. So I think just jump in. And I think it's important that people have a good understanding of momentum if you're going to invest in it. You have to understand the process itself so you can continue to have confidence in it. You have to understand the performance of it over the long run. So again, you can keep the big picture in mind. And you have to understand that in the short run, anything can happen. So you have to, again, have enough confidence and understanding that you don't get caught up on short-term noise that happens in the markets.
Thank you, Gary.
Thank you very much, Gary. It was a great, really great interview. I feel we just scratched the surface of your knowledge and wisdom, and this is really, really nice talking with you. Thank you very much.
Thank you. My pleasure. And you asked some great questions.
Thank you.
Money Masters Worldwide.
Learn to invest right now.